It's all very confusing. Alibaba, which is also e-commerce in China, says COVID-19 is hurting its results. JD comes out, e-commerce in China, and says that COVID-19 is helping their e-commerce sales. How exactly do you navigate that kind of market?
Yeah, well, the true litmus test of a great business is how you perform during crisis. If you look at Alibaba, I mean, they reported $5 billion in free cash flow this quarter, which is amidst one of the most challenging periods in China in decades. The company, as you mentioned, repurchased $18 billion of stock. That's 10% of its market cap. This just to put this in context, this is more stock that Alibaba has repurchased this year than Amazon has repurchased in its entire history. And the company announced another $15 billion repurchase plan. As you mentioned, Alibaba's growth has been, the headline is low single digits, but you got to put this into perspective that it was a 30% base last year. And so now the base is going to get much better going forward. If you compare this to Tencent in the last 3 quarters, that was minus 2%, minus 3%, and 0%. Just to put this in context, I mean, Alibaba is a $100 billion plus revenue business, and in the 1 billion consumer club. There are very few businesses in the world with that sort of size and scale. A Singles Day, a GMV was approximately flat. That's 85 billion. That's almost 2 times Amazon's. That's more than 2 times Amazon's holiday season sales. The company is, I would say that with JD.com, the company is certainly going to witness slightly faster growth than Alibaba. I would expect it to grow 15% over the next 3 years. The company's 1P sales are not growing as fast, but I haven't taken a look at the recent earnings results, but it's the net services line which is growing faster. And so I think, my focus here is the free cash flow of both businesses, which is the right parameter as to how to value a business. We can discuss that if you'd like.
So Sid, let's. We've only got a few moments left here now. Let's take us through. I mean, the opportunity that has happened over the last year and a half or so, in Chinese tech stocks getting beaten up, has created possible opportunities. What are your favorite picks then, as a portfolio manager? What's the most attractive right now in China tech?
Certainty in the stock market is expensive. When you have a deal, you pay a deal price for consensus. My top up pick is I prefer Alibaba and Pinduoduo over Jingdong. Alibaba's closing is trading at its closing price in its IPO when revenues have gone up 15 times from 8.5 billion to 120 billion. Free cash flow has gone up 4 times since IPO, and it's still trading at close to IPO levels. The Warren Buffett indicator for total market cap to GDP ratio in China is currently 55%. In the United States, that's close to 150%. So my top pick is Alibaba for the very fact that it's aligned with China's long-term development goals, and the company generates a ton of cash. And I expect that to accelerate as the Chinese economy reopens mid-next year.